about every number you used. Every number was an opinion, right? You're saying, but I got it out of an accounting statement. An accounting number is an opinion. It's an estimate. Which is part of the reason that if you're looking at your company and you looked at it on Bloomberg, you looked at it on a 10K, you looked at it on Yahoo Finance, you often found different numbers for the same item. Operating income last year. Should be fundamental, right? So that's the first thing is the numbers that we take for granted are still numbers that are estimates. So different services can actually have different estimates. There used to be a few givens, like the risk-free rate. Right? You're saying, well, I did it in dollars, I was given the risk-free rate. The T-bond rate we used as the risk-free rate, but implicitly that's based on the presumption or the assumption that the US Treasury is default-free. So even those numbers that look like facts are not, and with accounting and market numbers, all bets are off. Second, the real world is a messy place. Messy place in what sense? Not every company reports what it should, right? Numbers don't end with 3 zeros. Numbers keep shifting, there are restatements. All of those things essentially played into what you had to do. Third, during the course of the semester, you felt the urge to blame me. Like when you got that optimal debt ratio of 90%, the email I got was, what's wrong with your spreadsheet? Why am I getting 90%? I know I'm not trying to pass on responsibility here, but the fault lies in you rather than in me. The numbers came from you, and here's what's driving it. The spreadsheet just basically takes the numbers you've given in. So if your inputs are off or your operating income has an extra 0 on it, guess what? Your optimal debt ratio is going to go to 90%. So this doesn't come right away. I know the spreadsheet acts like a black box, and by 4 o'clock this morning it was really the black box driving your number crunching. At some point in time, though, you've got to realize that you're running the tool, not the tool running you. It takes a while because it's so easy to pass on the responsibility. But if you keep working at it, you will start recognizing that these are tools. We have the advantage of more sophisticated tools than people 20 years ago, 40 years ago, but they're still tools. And finally, you realize your project was never quite done, right? Just when you put that last I across the last T, new 10K, new 10Q comes in. Market price changes, new story hits about your company. Get used to it. That's the way both corporate finance and valuation are. Change is the only constant. Everything changes all the time, which is part of the reason if you look at your assessment of your company today, that company's been assessed before. So you take a company like Apple, it's been done probably 18 times in the last 20 years. You can go back and check what the numbers for Apple look like over time. They're going to look very different year after year after year. That's why early in the semester I got a few emails from people saying, I'll check last year's summary. Why you would do that, I don't even know. And I said, should I change my company because somebody did it last year? It doesn't matter. In fact, I didn't even stop you from assessing a company that somebody else in the class was assessing, right? You didn't know that, but you know. You know what the most assessed company this semester was? Take a guess. What company do you think? There were 11 people who did this company. Whole Foods. You know what the second most assessed company was? Netflix. You know the third most assessed company was? Chipotle. I know everything about your consumption taste just based on the company. Okay. The Whole Foods threw me off. I expected some Krispy Kreme, but Krispy Kreme is such a, war zone right now. You can't even assess the company. In fact, the reason I don't stop people from assessing the same companies, I'm going to show you one of the most scary tables that I get to see. So here's what I did. After I got all the summaries, I took all the Whole Foods and I put them together. These are all the people who did Whole Foods. I want you to look at the numbers that you got and recognize why it's okay. I don't care that you do the same company because not a single number matches up, right? Every single number is off. And that's okay too, right? There are some that are a little off. So if you're way off and you're one of the people on the group, maybe you want to be the one to go back. You have until 5 o'clock. You have time to revisit. Okay? So notice that every single number is different. Okay? Forget about the value per share where you can talk about differences. The price per share is off because even though I told you to get Friday's price, I mean, you were taking 2 weeks ago, 1 week ago, so the price can vary. The optimal should be pretty similar, except there's an outlier there. But that could be because you did a what if on the operating income. The actual debt ratio, that 8.2% is a little. You know what my guess is? If you're the 8.2%, maybe you want to check this. Check your operating lease commitments. Because if you don't count those, Whole Foods doesn't have much debt. I know it's too late. You're saying, I don't want to rewrite the analysis. You don't have to. Just send me a note saying, I forgot the lease commitments completely. I don't know what happened to me. I don't know. Netflix was even, the value differences are much, much, much wider in Netflix. And we'll come back and talk about that. That I expected, that the value difference, because Netflix is a company in motion. And the narrative you tell about the company, and we'll talk about narratives for companies, can drive the valuations. Okay. So there are lots of companies with multiple people doing them. Apple was actually 6 people did Apple, so Google had like 5. I was surprised. We could expect Google or Apple to be on top. Okay. So the whole class started going back 24 sessions to where the power lies in a company, right? Who runs a company? In fact, I was watching a crime show yesterday, and I like reading novels about crime. And one of the key questions is who benefits? When you look at a crime, a murder, whatever it is, who benefits? Because the answer to that question often is whoever committed the crime. Same thing applies in corporate finance. Where does the power lie? Because once you answer the question, everything else about the company starts to make sense. And if you think about this picture that we started with, the managers might be at the center of the game making decisions, but we talked about 4 linkages. Stockholders exercising power over managers, if they can, through the annual meeting, through the board of directors. How the company interacts with lenders and bondholders, and how it interacts with financial markets and its relationship to society. In the utopian corporate finance world, stockholders have complete power over managers, lenders are fully protected. Information comes out to markets the information is revealed honestly and on time. Markets are rational and cool about the way they assess the information. And there are no social costs. But we said that's a utopian world. And one of the first tasks you face with your company was addressing where the power in your company lay. And it was a very subjective, difficult assessment because there is no number you can look at. It's a collection of things. Voting power on different classes of shares, voting power on the shares, corporate governance rules, who's on the board of directors. All of those things went into your judgment as to where the power lies in your company. So I asked you to make a judgment. Basically, I said, in your company, tell me whether the power lies entirely with managers, it's midway between managers and stockholders, or is it truly a stockholder-driven company? So here's the first number you sent me. This is the breakdown for your companies on where you think the power lay. Right? In about 39%, I got the summaries for 305 companies out of the 330, so there are about 25 of you that didn't send you summaries. Send it in as soon as you can. I'll put that into the final spreadsheet. But among the 305 companies for which I got the data, about 39%, you picked managers as essentially running these companies. Stockholders have no power. In about 46%, you said there's some mixed power. Stockholders have some power and managers have some power. And in only 13% of all companies did you feel that stockholders essentially ran the company. The next time you see this frantic article written about activist investing and how stockholders have taken on too much power, remember this. Across the 305 companies, only about 45 companies look like companies where stockholders essentially had power over the company. And that doesn't surprise me. And that number hasn't shifted over the last 22 years that I've asked for these summaries. That number has stayed around 13 to 15%. So we read news stories about the Carl Icahns of the world and the Bill Ackmans of the world, but those are just news stories. The overall trend line is not there towards more power for stockholders. In fact, the way I see it is we go through ebbs and flows of stockholder power. where there are periods where stockholders have no power at all and periods where they accumulate some power. But there has been no trend line over time. When I get your reports, I'll also break this down into foreign companies versus US companies, small companies versus large companies. And historically, at least, here's what I found. There is a little more stockholder power with US companies than with foreign companies, and a little more stockholder power at large companies than at small ones. That kind of surprises most people, but at small companies, insiders tend to have more power because they accumulate insider ownership that allows them to control the company. So that's the first stop, and as a sub question, I also ask you, who's the marginal investor in your company? I didn't ask this for your summary, but I will pull this up when I get your reports. In the spring 2014 reports, and the reason we care is why? Why do we care who the marginal investor in your company is? What does it allow us to do? Why does it matter whether your marginal investor is an institutional investor or an individual investor? Think about risk. How do we define risk? We define risk through the eyes of the marginal investor in the company. If that marginal investor is diversified, then every risk and return model in finance goes through. If they're not, then you're in trouble. So the question is really about, are you okay using betas to get a cost of equity? And in fact, if you look at the breakdown, most of your companies, institutional investors, were the marginal investors. I don't know yet because I haven't read your reports, but most of the companies, spring of 2014 at least, and it was far more likely with large companies and institutional investors were the marginal investors in those companies. Smaller companies, you got a little bit more of a breakdown. For those of you who did find that individual investors dominated your company, your life got a little murkier because you couldn't just use beta. You had to think about what kind of risk should I be building into my cost of equity. And at the limit, if any of you did private businesses, and I don't think anybody in this class did, then you face the challenge of scaling up the beta to reflect the rest of the risk in the company. Then we got to risk. And when we thought about, when we measured risk, we looked at risk through the eyes of the marginal investor in the company. That's the entire basis for using beta. So whether we use a regression beta or some other beta, whenever you use beta, you're measuring only the portion of the risk in your stock that cannot be diversified away, or market risk. Okay? That market risk reflects the type of business you're in, what kind of fixed cost structure you have. The greater the fixed cost you have, the higher your beta, and how much you borrowed. And your equity risk premium reflects where you operate, not where you're incorporated, but where you operate. So you could be a US company. If you get 40% of your revenues from emerging markets, your equity risk premium should reflect it. So that country risk premium is going to show up for most companies which have operations at least in some emerging markets. And your risk-free rate has to be in the same currency in which you're doing your analysis. So if you're doing it in dollars, it's a dollar risk-free rate. If it's in euros, a euro risk-free rate. If you chose a currency, if you had a currency where you could not get a default-free rate, you had to do some cleaning up. You had to start at the government bond rate and work backwards. So the rupee or rupiah, peso or real, to get to a risk-free rate took some work. But those are the numbers that went in your cost of equity. So let's talk about regression, the way you can estimate betas. There are two basic ways we look through. The first is the standard textbook approach. Run a regression of returns on your stock against returns on the market index. The slope of the line is the beta. Go back 23 sessions for that regression line. The problem with the regression beta is it's backward looking. By definition, because I have to look at past returns, I can look at future returns, and it comes with noise. That's standard error on that estimate. The alternative we looked at was a bottom-up beta. You tell me what business or businesses you're in. You struggle with this with your companies because it was tough to slot some of your companies into businesses. The beta for your company is a weighted average of the betas of the different businesses you're in, with the businesses coming from looking at comparable companies in each business. And once you got that unlevered beta for your company, you scaled it up to reflect the leverage in your company. So I asked you to make a choice. But I pushed you, right? Every semester I keep pushing, hoping that one of these days my graph will look like all bottom-up betas and no regression betas. Never happens. I mean, you can see that my bias kind of pushed you towards bottom-up betas. About 265 companies you're using bottom-up betas. The rest were regression betas. I haven't looked at your report, but I can almost read the report that is going to back up the use of a regression beta. So here are some of the reasons I expect to see. The first is my company is so unique I could not find comparable companies. Okay? I'll let that go for the moment. Right? But if you have a unique company, it's because you've defined your business really narrowly. And last week I got an email from somebody in Chile saying she was trying to get the beta for a pet cemetery business. I'm not kidding. In Chile, and she could not find publicly traded pet cemetery businesses. Did I have any ideas on where she could find these? So maybe in pet heaven. I don't know. Right? But if you define your business really narrowly, you will get unique companies. And remember the two ways in which you can expand your sample. One is to globalize, because if you're staying local, you might have too small a sample. The other is to expand your business to include companies feeding in or feeding out. Right? The second is that your company is in one line of business, therefore you don't need a bottom-up beta. Is that true? You can be in one business and a bottom-up beta still has the standard error savings. Right? The law of large numbers still works. So bottom-up betas are not just for multi-business companies. And here's the third one. And this I got a lot of emails on. I've done my bottom-up beta. My bottom-up beta is 1.8. My regression beta is 1.15. It's too different. What should I do to make it closer to my regression beta? Now let's back up. Why do we do bottom-up betas? Because if we use bottom-up betas only if they're close to regression betas, this was an immense waste of time and resources, right? The reason we use bottom-up betas is because they will be different from the regression betas and sometimes very different. And the argument we're making is when you get betas that are very different, you should trust the bottom-up beta more. So I know that the sales pitch is not over. Obviously, I'm not going to penalize you for using a regression beta. It's perfectly okay. But I think that it's very dangerous to do both corporate finance and valuation using a regression beta. So the fight goes on. So I will continue this process of pushing towards bottom-up betas. But you can see that the bulk of your beta estimates come from looking at the businesses and building up. For some of you, that job was easier than others. For some of you, it was actually more difficult to slot your company into a business. And that choice you made actually feeds into how you think about your company. For instance, if you look at Netflix, what business is it in? I mean, directly streaming business, but if you define it's an and if you keep moving back, it's an entertainment company, especially as it, so you could define it very broadly as an entertainment company or more narrowly as a company delivering entertainment products, but you can actually see that that vision of the company will come back later when I ask you what's the value attached to Netflix as a company. And here's your distribution on betas. Okay? Your average beta was about 1.11. Your median beta was about 1.09. Already you're starting to see a selection bias in the kinds of companies you pick. You pick companies that were a little riskier than typical companies. Why? Because you tend to get attracted towards the Googles, the Apples, the Netflix. The young growth companies are so much more attractive to analyze. So you see that reflected here. The lowest beta, at least according to your summary sheets, was a 0.22. And the highest beta was a 3.80. Either because that company was in a really risky business, or my guess is that there was some leverage here that was unusually high that pushed up your levered beta to 3.80. Right? The other twin variable you get out of the regression is that intercept, which you compare to the risk-free rate times 1 minus beta to get a measure of whether your stock was a good investment or a bad investment during the period of the regression. Two key words there. One is was. This is a backward-looking number. It's got nothing to do with the future. It's a post-mortem. Second, relative to the market. And after adjusting for risk. So it's a backward-looking assessment of whether your company did well or badly. I don't have the median number, and I should have reported up here, was about 15%. Your median company was not just risky, it also tended to outperform the market. Okay. Which again doesn't surprise me, and it's partly my fault because when I asked you to pick a company, I essentially shut out sectors, right? I said don't pick financial service companies, which actually cut out a lot of negative alpha companies over the last few years. And what is the other limitation I put on you? Don't do any money-losing companies. By forcing you towards money-making companies away from financial service companies, I kind of skewed your Jensen's alpha upwards. But this is again a phenomenon that repeats every semester. We have high beta, positive alpha companies being picked because that's what you tend to get attracted to. Okay? The R squared measures how much of the risk in your company comes from the market. And this is the only risk we build into our beta and the cost of equity. Your median R squared was about 18%. 1/5 of the risk in your typical company came from the market. 4/5 came from the firm itself. We're not counting that 4/5 in our cost of equity. That's the big step we take when we say the cost of equity for a publicly traded company should reflect the risk seen by a diversified investor. The highest R squared you had was a 58% R squared. For CSX, there were about a dozen companies with R squareds between 1%, 0.5%, 2%, partly reflecting the fact that you had some companies that had been listed only 6 months, 9 months, 1 year, and partly because you had a lot of noise in some of the companies. That cost of equity fed into a cost of capital. And cost of capital is a weighted average of your cost of equity and your after-tax cost of debt. Let me be very specific again. The cost of debt is the rate at which you can borrow money long-term today. Right? So it's a risk-free rate plus a default spread. That default spread for some of you came from having an actual rating for your company. If you have an actual rating, might as well use it. But if you did not have an actual rating, which was true for about maybe 75% of your companies, you had to estimate a synthetic rating based on the interest coverage ratio. Those fed into a default spread. There's a 1 minus tax rate that shows up here, which is a marginal tax rate, which for US companies would have been 35, 38, 40%. But if you're doing a non-US company, might have been lower. The weights were supposed to be market value weights for equity and debt. And so at that stage, we brought in the fact that we should treat lease commitments as debt that fed into your debt ratio and the cost of capital. So here's what your actual debt ratios look like across your companies. There were about 6 companies which had no debt, neither lease debt nor interest-bearing debt. There were about 100 companies with less than 10% debt ratio. Many of these might have had no conventional debt, but because of the lease debt, that showed up. And there was actually 1 company with a 90% debt ratio, a couple with 80 to 90%. So there were some basket case companies, at least in the sample, with really, really high debt ratios. Okay? We'll come back and look at the optimal debt ratios, but you can already see that if you compute the median debt ratio, the median actual debt ratio was about 20%. Across the company. So that was the typical debt ratio for a company. Once you had the cost of capital, I asked you how good are your projects. And I gave you 2 ways of assessing this. One is to look at it from the equity investor's perspective, where you took net income and divided by book equity to come up with the return on equity. And you compare that return on equity to the cost of equity. Already some of you had issues because your book equity can become negative. Remind me again how that happens. How does the book equity become negative? You keep losing money, or you do a big stock buyback. Either way, you can end up with a negative book equity. If you have a negative book equity, your return on equity becomes not meaningful. You can't divide your net income by a negative number and say, my company is taking bad projects, because your denominator is the negative number, not the numerator. So you compare the return on equity to your cost of equity. The alternative is to take the after-tax operating income net of taxes, divide by the invested capital, which is debt plus equity minus cash, and you come up with the return on capital. You compare that to the cost of capital, and you get a spread. If you make more than your cost of capital, at least based on that return on capital, it looks like you're earning excess returns. So I asked you to compute both numbers for your company. Here's what you found. The median return on capital spread that you came up with was about 10%. Your typical company earns 10% more than the cost of capital, which goes with your earlier, with what we found earlier. You tend to pick risky companies that have done well, that have earned more than their cost of capital. That gets reflected here. Your return on equity is also on this graph. That median number was a little higher because you tend to have more outliers as well. Okay? So that's what the spreads look like for your companies. And then we got to capital structure. And I say, what's your optimal debt ratio of your company? This is the point where you just plugged into the capital structure spreadsheet and hoped that something didn't blow up. Right? And once in a while it did, in which case you had to copy the whole thing. It's a problem with it. That iteration box makes things a lot messier in the spreadsheet. Your spreadsheet goes to spreadsheet hell, let it go. Just take a fresh spreadsheet, enter the numbers in. The optimal debt ratios that you came up with are here compared to your so you're both your current and your optimal. Your median optimal debt ratio is 40%. So that guy who asked me at Bankers Trust, can I use 40% for every company? Wasn't that far off this semester. Okay? Your average across your optimals was 35.7. Your high was 90%. And I'm going to list the companies, and you can probably see why they end up with really high optimals. Rio Tinto. In fact, there are a lot of oil companies which ended up with 70, 80% optimals. Commodity companies collectively this semester ended up with really high optimal debt ratios. Why is that? Because the operating income came from a trailing 12-month or last year's data, right? And last year's data reflects oil prices and commodity prices that are much higher than the prices today. You're saying, isn't this a flaw in the model? Not necessarily. The model is just saying, if we can keep making what we did last year and market caps are down to what they are now, you should be borrowing money like crazy and buying out the shale oil companies and commodity companies. There's a judgment call to make. You have an optimal, you have an actual. You don't have to move to the optimal. You have to make the judgment call with Rio Tinto or Conoco or Chevron. Your decision might be that operating income reflects an $85 or $90 oil price. We're at $55 or $60 oil prices now. I'm not going to move to the optimal. In fact, you can build in a much lower operating income reflecting the lower oil price. And my guess is the optimal will come down. You might still be underlevered, but you're not going to do a leverage buyout of Rio Tinto. The other group of companies was actually very interesting. A lot of retail companies ended up with really high optimal debt ratios. A couple are listed here. Gap and Best Buy. In fact, collectively, this was a problem that people who were doing retail companies discovered, is their optimal debt ratios were much higher than they expected them to be. What do you think is driving that? I mean, clearly, the numbers seem to suggest these companies can go out and borrow a lot more money. But what might hold you back here? Think Amazon, and I think you will have the answer. These are brick and mortar retail companies, right? And what you're discovering in the market is this fear that these companies, it's only a matter of time before the margins come down, because basically they're competing against a behemoth that's just throwing things and saying, I don't care whether we make money. Amazon's selling stuff at cost, and you can already see the damage it's created in the brick and mortar retail business. In the form of shopper image. I mean, you can look at the list of companies that have essentially been driven out of business. Radio Shack might be the next one on the list. But essentially, what the market is building in is an expectation that even though the numbers look good, these companies right now, you might not want to go out and borrow a ton of money and do a leveraged acquisition or recap of these companies, because you're in a business where your margins are going to be under downward pressure constantly. Okay. So those are your average and optimal. This semester at least, I think out of the 305 companies, 225 came out as underlevered. About 80 came out as overlevered. Your typical company was underlevered by about 15%, which doesn't surprise me, because as the risk-free rates have come down and risk premiums have kind of nudged down as well, the optimal debt ratios have climbed for companies. Companies have more excess debt capacity than they did last semester or 2 semesters ago, 3 semesters ago. Your most underlevered company was KDE, which is underlevered by about 79%. Your most overlevered company was Lionsgate. Okay. So those that 80% though for Lionsgate, I don't know whether that's I mean, that would suggest the actual debt ratio for Lionsgate is 90%, or so I'm not sure. So this is the number you sent me. I'll have to look at the Lionsgate. Maybe you put it was 8%, it was late in the evening, and you put 80% or whatever it is. But that's according to your numbers. Lionsgate is the most overlevered company in the sample. And I ask you what the right kind of debt for your company was. Many of you tried running that macro duration regression. You got some really weird looking numbers. But I sent you a warning on Thursday saying, when you run that regression, remember you have 10 observations, and all you need is one outlier for everything to kind of blow up in your face. So I suggested as a fallback that you think about what kind of company you have, what type of projects it takes, and go back to that assessment to decide what your debt should be. Because when you run the regressions, here's what you're looking for. How sensitive is your firm to changes in interest rates drives the duration of your assets. Because what you're looking at is for every 1% change in interest rates, how much the value of my firm changed by. So that how sensitive your firm value is to changes in GDP tells me how cyclical your firm is, which might hold me back in terms of how much I borrow. How sensitive your firm is to inflation tells me how much pricing power you have. And the more pricing power you have, the better you are as a candidate for floating rate debt. And how sensitive your firm is to changes in exchange rates tells me whether I should be using non-dollar debt or non-local currency debt in funding your operations. So that brought us to the end of capital structure. Let's think about dividends. The key number on dividends is what your potential dividend is, the free cash flow equity. Free cash flow equity is the cash left over after you've met every conceivable need. So you start with net income, you add back depreciation, you subtract out capex and change in working capital. If you have debt repayments to make, you pay those out as well, but if you borrow money, that's cash coming in, you come up with the free cash flow equity. That's your potential dividend. You don't have to pay it out, but if you don't pay it out, it accumulates as a cash balance. So I asked you what your free cash flow equity was in dividends, where I should have been more specific about, I said the average or the aggregate. It really didn't matter to me because I was going to take a percentage, but I probably cost you some time. I shouldn't have, I'm sorry. But the dollar dividends and dollar free cash flow equity, or whatever the absolute numbers, is what I use to compute your dividends as a percentage of free cash flow equity. There were about 61 companies which returned no cash at all, no dividends, no buybacks. Okay? At the other extreme, there were about 70 plus companies that paid out more than their free cash flow equity as dividends. So the companies, in fact, all of these companies are accumulating cash. This company, the 71 companies, of course, are burning through cash that they've already accumulated. Your median free cash flow dividends as a percent of free cash flow equity is about 55%. The typical company here, in addition to having high risk, has delivered positive alphas, has taken on projects that were good projects, also accumulates cash. For every $100 in cash, it accumulates $45. The average was higher simply because you had some outliers. Once you'd assessed the capital structure, the dividend policy, and the risk, I asked you what the value of your company was. I understand this came at the very end of the semester. It wasn't quite fair to expect you to delve in depth into the valuation because you really didn't have the time. But what valuation is all about is the story you're telling me about your company. Okay? So essentially, if you think about the two ways you can approach valuation, one is to put your equity hat on, look at the cash flows you get as an equity investor, which is the free cash flow equity or dividends if you want to be even more specific. Discount those cash flows back at the cost of equity. What you get as a present value is the value of equity in your company. Alternatively, you can take cash flows to the firm, pre-debt cash flows, discount them at the cost of capital. What you get as a present value is the value of the operating assets of the company. In fact, I'm going to show you the page that I showed you last session on how to get from your present value to your value of equity. If you're discounting dividends, you're done. You get the value of equity. If you're discounting free cash flows equity, you might have to subtract out any equity options you have due to management. In fact, the spreadsheet gave you that choice of, if you gave me the options, I valued the options and took them out of your equity, saying they don't belong to you. If you value the firm, then you have a lot of work to do. You have to add back the cash, you have to add back non-cash holdings, operating assets in other companies. And then you subtract out the debt and the value of the equity options to get to the value of equity in the company. Okay? So I showed you the page for Disney, but before I do that, let me show you what you found for your companies. Okay? And in fact, I've listed out last 8 semesters of classes, okay? Simply to show you how the patterns have shifted. So let me take your class. Okay? I think out of the 305 companies, 185 came out as overvalued, 120 came out as undervalued. You found more overvalued companies than undervalued companies. Your median company was overvalued by about 14%. You're saying that's because discounted cash flow valuation is conservative? Well, you go back to spring of 2009. The reverse was true. At that point, Out of the 300 companies, 200 came out as undervalued, 100 came out as overvalued. So there are patterns over time that reflect what's happening to market price and value. Right now, based on the numbers, you found more overvalued companies than undervalued. Not by huge amounts, but the median overvaluation is about 14%. So if you want, you can compare across time and look at what the market was at each point in time, and you're going to see some of that reflected in what you found in your company. That's basically what drives the value of your company. The judgment is not just the value of your company, but what you compare it to. So let me go back to valuation. There are 4 inputs that drive the value of a company: the cash flows you get, the expected growth rate, when your company would be a mature company, and what your cost of capital is, right? So if you want to change the value of your company, this is not something I asked you to do, but if I said, look, you now understand Netflix or Whole Foods or whoever you're analyzing, what would you do to change the value of the company? You got to change one or more of these 4 inputs. Every restructuring, that's basically what you're trying to do. Change the way a company is run to do something to your inputs. So let's go through the inputs. When you look at your cash flows from existing assets, the key question you ask yourself is, are these assets being used efficiently? If they're not, maybe by running them more efficiently, you can increase cash flows from existing assets. For the growth rate, I said it's a function of how much you reinvest and how well you reinvest. Those decisions, again, you can ask, am I investing enough or am I investing too much? Both can happen. If you're investing too much, you should cut back on your investing. If you're not investing enough, you should invest more, show up as higher growth. And for your cost of capital, you have to ask, do I have the right mix of debt and equity? And is the debt that I'm using the right debt for me? Now you can see why valuation is the tail end of a corporate finance class, because these are the questions we were addressing all the way through the class. Because in the process, you're actually already thinking about valuation. Even though we did not explicitly bring in valuation, the decisions of how much to borrow, how much to pay in dividends, and what projects to take indirectly end up driving the value of your company. So this was the valuation I showed you for Disney in class on last Wednesday. The value per share that I got was $62.56. If you look at the top, it says Disney, November of 2013. In brackets, I should have said status quo, because this reflects the value of the company run by the existing management, with all their faults and all the things they do well. So my growth rate reflected how much they reinvest and what their return on capital is. My cost of capital reflects what they chose to use as debt and equity. I didn't impose my requirements on target debt ratios, and the value that I got was $62.56. So let's say I put you in charge of Disney now and say, what would you change about the company? And by this point, we've already assessed the optimal capital structure, the optimal dividend policy, everything about the company, right? So what I did was I revalued the company with 2 changes. One is I moved the debt ratio to the optimal that I'd computed in the optimal capital structure. And the second was I lowered the reinvestment rate and I increased my return on capital to reflect what Disney used to use 10 years ago, 12 years ago. With those 2 changes put in, the value per share that I get is almost $75. So the value that I got with the status quo is $62.56. The value with the changes that I think can be made in the company is $75. That's about a $12.50 difference. What should we call that difference? Hey, why don't we call it the value of control? This is what a control premium should really be about. It should be about valuing the company twice, once with the existing management in place and once with optimal management in place. And already you can see why the value of control cannot be 20% for every company, right? Because if you have a perfectly managed, perfectly run company already, the value of control is going to go towards 0. If you have a badly managed, badly run company, the value of control can be immense. This wasn't required on your project, but you already have a valuation of a company. If you get a chance, revisit that valuation, not for this project. After the exams are done, you have time. Revisit that valuation and ask yourself, what could this company change about the way it's run? Come up with a new value. That difference is the value of control in your company. Now, some of you had companies where you came up with the value. Netflix was an example, but there are others where you came up with the value. The value was much, much lower than the price. And you said, what am I doing wrong? In fact, you sent a spreadsheet and said, can you show me the input that I'm getting wrong? And my response was, why do you assume that you're doing something wrong? Just because your value is different from the price doesn't mean you're necessarily doing something wrong. And here's why. When you value a company, you're essentially looking at what the value of that company would be given its cash flows, growth, and risk, right? That's what a discounted cash flow valuation is. Most companies, if you look at how you come up with that stock price number, are not being valued by the market, they're being priced. Okay? Priced in what sense? Somebody's attaching a number to the company based on how other companies just like it are trading at. In fact, if you look at Disney and you look at where it's trading, so Disney is right there, relative to the market, I've listed PE ratios, growth rates, and a ratio called the PEG ratio, which is PE divided by growth. You can very quickly see that I can justify a pricing for Disney based on those other companies. So if you're looking at a Facebook, you're trying to do an intrinsic valuation and you don't get a number close to the price, hey, it might not be anything in your inputs. It might reflect the fact that Facebook is being priced against Twitter and LinkedIn, and relative to those companies, it might look okay. Much of what happens in the market is pricing, and it's a point I made at the start of the valuation. But if you're puzzled about why your value is different from the price, maybe you can take a different look at the company. Look at it relative to its sector, and you might find that the way it's being priced reflects what other companies in the sector are being priced at. So here are your most undervalued stocks. Again, take it with a grain of salt because, again, it's the tail end of a project. But your most undervalued stocks, there's your value per share, there's your price per share. Okay? It's quite an odd mix of companies here. Right? Is GoPro actually trading at 16? It doesn't sound right to me. Maybe you got the price and the values, which maybe, no, it could be. Maybe the 16, as I said, I just take your numbers and I put them in there. I didn't move them around, so don't blame me. Right? No. Apple at 105, what? I don't know. Because there are two Apples here. One says 127. The 127.60, I follow Apple every day. It's close to the price today. The 105 reflects a price frozen in time, probably around September. That's another thing, though. Remember that just because your annual reports end in September doesn't mean you do the valuation as of September 30th of 2014. Because what's the point? What are you going to do with that? Okay? So even though your numbers are going to reflect a point in time in the past, so take it for, first check the prices to make sure you're not doing something crazy. Maybe the numbers are being transposed. But that's essentially what you fed me in your summary sheet. Right? So one final piece of this puzzle, because when you look at these companies, you're looking at leverage, you're looking at dividend policy, you're looking at the projects they take. I compute based on what the numbers you send me, what I call a triple whammy. These are companies that are underlevered, their actual debt ratio is lower than their optimal, are building up cash, and are undervalued. You see why I call it a triple whammy? Because on these companies, I have three things that could potentially work for me. Their leverage could go up, which will increase my value. They could pay more in cash, which will increase my value, and they're undervalued. So it's actually an interesting list. If you are an activist investor, those are the kinds of companies you'd want to target in your list. So these are the companies that I pulled off that meet all three criteria. They're underlevered, they're undervalued, and they're paying out less than their free cash or equity as dividends. So out of your 305 companies, these were the only ones that made the list. So again, take your, I think Whole Foods showed up twice because I think you sent it in 2 different times during the course of the evening. But basically, it's not the same. It's 2 different groups. It's exactly the same numbers. It'll be very suspicious if that were the case. I don't think it is. But those are the companies that met all three criteria. So it's a page I showed you at the very start of the class. Let's revisit that page. And let's see if, in fact, at the end of 25 sessions, there is some heft behind each of those things that we said up front. The investment decision says you have to go out and find projects that earn a return that is greater than your minimum acceptable hurdle rate. Right? And we said the minimum acceptable hurdle rate should reflect the riskiness of the investment. In this stage, we have a much clearer, hopefully, definition of risk, both for equity and debt, and should reflect where you get the money. The return should be based on cash flows, when you get those cash flows, and have all side effects built into them. When we talk about the financing decision, we're talking about both the right mix of debt and equity, which is the one that maximizes your value and minimizes your hurdle rate, and the right kind of debt, which is the debt that best matches the assets you have as a company. And when you think about cash return, again, you're thinking about how much cash can I afford to return. That's the whole point of computing that free cash or equity. And what form you return it, either dividends or buybacks, should reflect what kind of investors you have as a company. So as you grapple with all those numbers about your company, what I'd like you to start thinking about is, if I asked you to write a narrative for your company, a story for your company, whether that story is something that you can write, that you can use to describe where the company is now and where do you think it's going to go in the future. Because that's what your valuation is supposed to reflect. And again, I'll use Netflix as my example. If you view Netflix as a company that is primarily a streaming company, its revenue growth is going to be constrained because it's a very competitive business, which is going to drive its value down to the lower numbers. If you view it as an entertainment company, which increasingly is going to produce original content, it's going to show up. In fact, Netflix is a company that I think brings home this point about treating commitments as debt, because it has those streaming commitments that are huge. But it needs them, right? That's how its actual revenue. If you're a subscriber to Netflix, it's almost all pure profit for Netflix when you pay that $8 per month. So that investment they make in locking up the content is their biggest investment. It's the biggest debt they take, the biggest asset. That's what you're bringing onto the books when you capitalize that. And that's why it makes such a difference whether you capitalize or not in terms of what you think of as its return on capital and its cost of capital. So I listed 3 objectives for the class. At this stage, I don't know whether the third objective should be even brought up. Okay? This is a class about the big picture. I know you've been stuck in the details, especially right now. What I'd like you to start thinking about is, lift your head up, elevate. Think about the company as a whole. Think about all those numbers and where they went into the big picture, because that big picture matters more than the individual details. You forget the specifics of this class, hopefully sooner rather than later. Maybe you'll have nightmares about it for a few weeks, but then it'll pass. Okay? But the big picture is something I want you to do. So the next time you look at a company, I want you to step back and think about what the company does and how it all fits together. Second, lots of tools, lots of equations, lots of models. But remember, they're just tools. You can always review the tools. But if you get the first principles, the tools become much more usable. As I said, the third objective, I was going to say corporate finance is fun, but at this stage that might be hitting a sore spot. It's not that bad. It could be worse, and it's over, pretty much. Okay? That's the best part of it. Couple of things. One is you have to do the CFE to get your grade. So this is purely selfish on my part. Do the damn CFE, because I know exactly what's going to happen if you don't do the CFE. About a week from now, you go to check your grade, and you won't be able to see it. Then I know what's going to happen next. You're going to email me asking for your grade. And I have a very simple rule. End of this week, actually start of next week, I shut down any email from corporate finance. No longer makes it through. For about 3.5 months, it's all shut off. So do your CFE, and you have 3 days to do it, like tomorrow. So I'll send you the directions. If you've never done a CFE before, I don't see how that can be. Maybe you're not a Stern student. I'll send you the directions to get the CFE done, because you have 3 days. It takes about 5 minutes. It's just choosing numbers. Just be glad that it's only 8 questions now. It used to be, I think, 22 questions before they put me in charge of a committee to write the CFE. So if you're at the Stern Follies, you probably saw this. This was my version of the CFE that never made it through, because I showed up at the first meeting and said, do we have to keep meeting? I hate meetings. I had the CFE all rewritten, so why didn't we use it? They didn't like the way I wrote it. But there's a version of this online, which is a much more formal version. So there are only 8 questions on it. Make sure you get the 8 questions done. Now, if you don't want to leave a comment, that's fine. They don't penalize you. Just get the CFE done. A couple of things about the final exam. This is why I made you come. This final exam, as you know, is Friday from 10 to 12. There is a earlier version of the final exam. Everybody's taking notes now. I'm going to give you that. Don't worry. This stage, is when I should get the webcast turned off right now. So this should be a payoff to showing up at 10:30 in the morning. Okay? There is an earlier version of the final exam on Thursday, but only by invitation. So if you're a second-year MBA and you have stuff happening on Friday, or you got my permission already, Thursday from 9:30 to 11:30, there's an earlier version of the final. It's not the same final, so don't be torturing people after the 11:30 when they come out saying, can you show me the final? No, it doesn't matter because it'll be a different final. But most of you I will expect to see on Friday from 10 to 12. We've got KMEC 260 this time, so we will have more space to spread out in both rooms. I'll send you the email about seating for the final. And there will be a review session on Thursday from 12 to 1 in 170. I know lots of rooms floating around, but again, I'll send the email out. 12 to 1 on Thursday. I was thinking about doing it earlier in the week, but there's no point. You won't have a chance to review before you come to the review session. So Thursday, 12 to 1, hopefully by then you'd have all the material kind of nailed down. Lots of material, right? So let me give you some suggestions on how to prepare for the final. Don't go back to page 1 of packet 1 and start reading. You will never get through. Okay? The final has 5 questions on it. Now take this down. This is secret. You know, nobody. The same 5 questions you've seen in every final going back to 1997. Okay? Question 1 will cover betas. That's a big area. It's quiz 1 material. Question 2 is investment analysis. Quiz 2 material, net present value, IRR, project analyses, your Apple, iCar case. Question 3 will cover capital structure, quiz 3 material. That's 60% right there. But 40% is for material we've done since the last quiz. So question 4 is dividend policy, question 5 is valuation. So here's what I'd suggest you do. Start from the back and work, so start with the last 6 sessions and work backwards. So get the last 6, because it's going to be 40% of the final, right? Start with that. In the course of doing your valuation problems, you're going to discover your weak spots on betas. You will have to revisit those earlier sections. But the breakdown is going to be 20% for each problem. Basically, the first 3 problems will be the first 3 quiz material. Quiz 4, quiz, so no, there's no quiz 4, quiz 5, but problem 4, problem 5 will be what we've done since. If you missed any of the quizzes, pay particular attention to that material because you probably didn't prepare as much on that material. Okay? So it'll be 2 hours, open book, open notes, as with every other exam. So I will send that email out with the specifics sometime later today, maybe tomorrow. No, I have my valuation class this afternoon. But I know it's been torture. The torture is over. Close. My torture is beginning because I now have to read all your torture stuff now for the next. But here's what will happen in your projects. I asked you if you have it, as you're sending in your projects, make sure you CC everybody in the group because when I grade your project, it'll be embedded. All the comments will be embedded in your project report. And the grade will be on the front page, and I will reply to everybody. I hardly ever reply all, but this will be the exception. I'll reply all. So everybody in the group should get your project report. When will you get it? I work sequentially. I already have 6 project reports. They will go at 5 p.m. today. And then I have to get the damn, I don't want this hanging over my head. I have other my son's graduating next Tuesday. So basically I have all these things I have to get done. So it will come to you as I finish grading it. Okay? Most of your cases or project reports will be back to you before the final exam on Friday. Okay? So if you don't get it, don't freak out. Sometime over the weekend it will come to you. Once you do the final, of course, then I have to turn my attention to the exam grading, so I'll get that done, then you get back to your projects. Your grades should be ready probably by Monday, Tuesday, somewhere around next week, maybe Wednesday, because I might be out of town. But it'll be early next week rather than like late next week. Okay? And that's about all the formal stuff. Thank you very much for hanging in there. And I might not get a chance to wish you this, but have a great summer, and I will see you next semester. Oh, I forgot to mention, Next year, I teach valuation only in the fall. So if you're trying to take valuation, you have to take it in the fall, because in the spring I teach 2 corporate finance sections, one for the undergraduates, so my usual valuation in the spring is being displaced by that. So valuation only once next semester, next year.
sociology?